Welcome back. You're watching Startup Central with me, Nandara Rai, the only show of its kind on Indian television dedicated to startups, innovation, technology, disruption, entrepreneurship. Let's now, talk a little bit about one really hot space, which is about lending to millennials. We talk about fintech anyway, which has been booming. And our next guest on the show is Yogi Sadana of CASHe, the CEO, who's joining us on today's edition. Thanks, Yogi. Welcome to the show. 2020 must have been a year where all your plans got accelerated. How was it? What is it looking like in the early part of 2021? The momentum that you saw last year, is it sustainable?
Yes, so Nandara, thanks for having me on your show. And yes, we are one of the pioneers in the fintech lending space in India. The problem that we are trying to solve with CASHe is basically to provide a credit solution to the young urban millennial, which is out there, who does not have full access to the credit products. And we are trying to create India's first and largest fintech platform, which can solve this customer's problem by giving him very curated products which can solve his credit products at the point of time where he needs. So it could be a personal loan, it could be a BNPL product to purchase something on an e-commerce platform, or it could be a digital credit card. What a consumer needs on his entire journey from a demand perspective.
Okay, now you lend primarily to millennials, and let's figure out the habits of millennials. Are millennials borrowing more now? The fact is, they've always said, we don't want to buy a house, we want to be asset light, we don't need to buy a car. But Corona has, of course, had a massive impact on the shared economy. So tell us a bit about the millennials' borrowing habits, and what are they borrowing for?
Yes, so Corona has basically changed a lot of things for the millennials and for everybody which is out there. I don't think people are looking to buy long-term assets for which they need long-term solutions from a credit standpoint. These are very demand-oriented loans. These are short-term demands that people have. It could be for a white good. It could be for a contingency at home. It could be for solving a short-term credit need that you have for rotation. Or some short-term need that a consumer may have. So I don't think that the consumer is looking at long-term assets, and for those long-term assets, people are looking for long-term credit. These are short-term demands that people have, which people are looking to solve at this time. Overall, the economy has moved to a very rental basis of economy. I call this as an Uber economy. If you look at in India at this point of time, the new kind of demand which is coming out is it could be for lease products, which could be for a car, it could be for your own home. So I think that's the new thing which is coming out. People and urban millennials in India are not thinking about owning a car or owning a house for which they need long-term funds. I think they are more demand-oriented, and their demands are very short-term in nature.
Okay, so that's mapping the borrowing habits of millennials. But from your perspective, Yogi, can you tell us how you are preventing delinquencies? How do you know about the credit worthiness of those that you're lending to, these young millennials? How do you even check it in the first place? And I've got to ask this, why are they coming to CASHe or other startups like yours and not to banks? Why aren't they going to banks?
Yeah, that's a great question. So basically, the reason why a millennial would choose a platform like ourselves is just for pure convenience, right? You will see a lot of large banks and financial institutions will not have a short-term product which a millennial needs at this point of time. It could be a product as short as 2 months to could go up to a 1 year. So we are one of the last mile financiers to these millennials, so that whenever they need this money, this could be available on a almost like on an instant basis over the platform that we have created. The other big differentiation that we have as compared to the large financial institutions which are out there is that we are not looking at the bureau information, which is used as a gatekeeper for underwriting by the banks and financial institutions. What we have done is that we have curated these algorithms which are looking at alternate data of these consumers and looking at what is their goodness behavior. That's what we call. It bases the amount of data that we have looked at, and the data that has gone through from these algorithms. We are very certain at this point of time that we are able to predict very accurately that what's the credit behavior of these consumers, and then make a decision on lending on that customer. So this is alternate to how a large bank or financial institution would look at a customer. This is alternate to how how the bureaus have been looked at. So this is a new way of lending, and it can only happen if you have a solid tech practice and if you have a large platform which can churn that much data and make sure that can give you the right result.
But Yogi, I respect all of that, but the fact is there will still be delinquencies. There will still be those that are not making their payments either on time or at all. You must be having some NPAs. How big or small are they?
Oh, yes. So look, in a lending business, you always have NPAs. If somebody comes out and says that we are lending and we don't have NPAs, probably there's something goofy out there. But at the same time, we have been able to control our NPAs at a very granular level. We look at consumers, as I said, with a credit decisioning policy that we have created using technology. So a combination of all the practices that we've put in place, our NPAs are sub 1%, 1.5% on every disbursement cycle that we do. So this is pretty much in control to make sure that we still run a business which economically makes sense.
Okay, now I want to ask you a little more about the millennials' borrowing habits. You told me what they're borrowing for, but what is the average loan size?
Sure. So look, we could give a loan as low as $10,000, and we could go this at the maximum range at about 3 lakhs. So that's the range at which we lend. Although the average of this is about 35 to 40,000. And typical millennials from us borrow between 3 months to 6 months. So that's a typical range of the period at which people borrow from us. So 35, 40,000, 3 months to 6 months, those are the tenors, and that's the size. So this will tell you that the amount of people that what are borrowing are generally for their short-term consumer needs and not for long-term asset creation.
Now, there's no such thing as a free lunch, okay? You're talking about how these young millennials who you're doing this fantastic creditworthiness check for as well, that you have very low NPAs, are coming to you to not, buy for cars or houses and things like that, but for short-term purposes. You would be more expensive than banks, I would imagine. You would charge a premium for that convenience.
So look, the loans that we provide are at quite competitive rates, and the rates at which we lend fluctuate and are tied to our products and consumer behavior patterns as well. So it's quite varied in nature depending on the risk that we take on the customer and the tenor at which the customer looks at. We make sure that these rates are pretty much in control, and we lend at rates where people can take money from us at lower cost as compared to what you would generally pay to a credit card to rotate your limits over there. So these are at very competitive rates, and we make sure that the customer does not take a pinch by borrowing money from a company like ourselves.
As for all the young millennials who are tuning in, they'll be like, it's convenient. You can get up to up to 2 lakhs or whatever. Average size is 35,000 rupees. It's not far more expensive than a bank. But Yogi, what about the repayment timeline? How different is that? Is the startup from, let's say, a traditional bank?
So look, all of our products are monthly amortizing. As a person, I believe that if as soon as you give long-term loans which are not monthly amortizing, the risk on that customer increases multiple fold, because the economics of the person changes after every 3 to 6 months. And if you tag along a large credit line to a consumer which does not amortizes, the credit risk multiplies multiple fold on the same customer. So all of our products are monthly amortizing. So what it simply means is that if you choose a 6-month product, you'll have to pay us 1/6 of it every month on the due date.
Okay. You know what we've also seen since 2020 is an absolute explosion when it comes to fintech. I don't think anybody expected the kind of growth we've seen. Now that has happened, there are obviously problems and challenges, whether it's from the bank's perspective, whether it is from the telecom infrastructure's perspective that is not able to handle this massive traffic. You've had that OTP problem earlier this week as well. So how are startups like you managing that aspect of the challenge?
So look, you're right. Probably India is going through a massive fintech evolution, or a payment evolution, where we are seeing more than 4.25 lakh crores of payments being processed through the UPI platform itself. Leave alone what's happening on credit cards, leave alone what's happening through other channels of payment. But if you purely look at UPI, that's a very, very big number, which we have been able to graduate to as a country. So with that level of exponential growth, there are some tech challenges or the infrastructure challenges that we are seeing, especially in the last couple of days, where we have seen some OTPs not being processed, some SMS issues that people are facing. But I look at them as challenges which are good and bad. They are good because they indicate that as a country we have evolved ourselves into a large practice of fintechs and digital payments. The problem associated with that is that it creates some sort of frustration where people have got used to a certain sort of behavior pattern. So if you create confusion over there, if those OTPs are not received on time, it creates a bit of frustration from a consumer perspective. So with whatever changes that the government wants to do, whatever regulator wants to do, I think these needs to be tested and make sure that the larger footprint and the larger agenda that we are trying to drive as a country for digital payments, that's not suffered because of these changes.
Final question to you, Yogi. What can we expect from CASHe going forward? How are you going to stay relevant? What are your plans? Now, this is a space which Amazon wants to have big moves in. You've got Jio, you've got Paytms. How are you going to withstand competition from all of these biggies?
Again, good question, Nayantara. So basically, look, lending is not the most easiest thing to do in the world, because you have to, you cannot look at lending as distribution money, because at the end of the day, you need to be successful as a lender. And to be successful as a lender, you have to make sure that your NPAs are in control. You still make economic sense, and you can't do lending just on pure equity, right? So this is a completely different ballgame, where you need to have a combination of equity and debt on the balance sheet. And on the customer side, you have to make sure that you have some very engaging products to stay relevant from a consumer demand perspective. And that's what we have done over a period of time. We have evolved as a company. We started by only giving short-term personal loans. We have evolved as a company, and we have created a platform at this point of time where a consumer can choose to borrow for a personal loan, where money can be given in his personal account to meet a contingency or meet a demand. We can also finance consumers' BNPL requirements, so we can give a voucher which could be used on an e-commerce play. There is tremendous amount of benefit of using that payment channel, because these are highly subvented loans that a consumer gets. So from a cost standpoint, consumer can save a lot of money by using that product. We are also coming out with a digital credit card. So basically, if you don't like to buy something from an e-commerce platform, or there's a store which is near your home, which is giving a very competitive offer that you would like to do, we can actually give money on a digital credit card, where you can go and use that credit card and buy that product that you like. So we have expanded our horizon of products from a single trick pony of being just a personal loan provider to a BNPL loan solutions, and also to this digital credit card, which should come out in the next quarter or so. So if you look at it holistically, it's a company where a customer can choose the product that he likes, and there's high engagement on the platform, depending on the choice of the consumer's demand at that point in time.